Welcome back, everyone, to Off the Block. I hope you guys are all doing well. The last time we covered Hyperliquid, we talked a little bit more about the human story, how the platform took off, who was there early, and what most people still overlook. Today, we're going to mirror that conversation with a deeper look under the hood, under the infrastructure, the architecture, the staking mechanics, and what it actually takes to engage with this network at an institutional scale. So joining me today, pleasure to have a co-host today is Chrisan, our portfolio manager at 21 Shares and part of our broader investment team. Chrisan oversees the suite of ETP products here in Europe and also over in the US. And with us as well is our RR2 guest from Figment, one of the largest institutional staking infrastructure providers in the industry, and a team that we're very happy to partner with across a lot of our different products. So Josh, Luke, I'll let you each take 30 seconds to introduce yourselves.
Great. Thanks, Max. Thanks, Dr. K, for having us on. Obviously, we work really closely with you guys and share your sentiment about the partnership. So I look after revenue at Figment. I'm based in North America. I'm specifically Boston. I've worked in the crypto industry for almost 10 years now. Was previously at Fidelity, previously at State Street. The fact that we now have a institutional grade decentralized platform like Hyperliquid, given all the amount of work that's gone into this, into developing crypto products over the last 10, 15 years is really remarkable. And, we'll give a little bit of an update on what Figment is later, but we are, as you said, Max, one of the largest staking providers and stake hype amongst a number of other assets for folks like 21 Shares and other institutional style Fs, asset managers, banks, broker dealers, etc. And Luke, I will pass it over to you.
Awesome. Thank you. Yeah, I'm Luke. I'm also at Figment and I'm on our protocol team here. So that involves wearing a lot of hats, but I think the biggest and primary one is just being the resident expert, if you will, or as close as you can get to that, on all things new networks. So a lot of new networks that we're looking at these days, but I think Hyperliquid is definitely one of the most significant. So yeah.
And just to plug Luke for a second, he wrote a primer last year on Hyperliquid before anyone really knew what it was, and is the piece that I still go back to and reference today when I have questions on the network. So we can maybe link that in the show notes.
Yeah, Josh, you were going to beat me to it. I definitely took a look at it as well before joining today, and I definitely want to give credit to you guys where it's due. So as you guys can see, Figment has been covering Hyperliquid for quite some time now as well. So before we go into the architecture, I do want to definitely dig a little bit deeper there with you, Luke. I think it's worth maybe giving listeners, who hadn't caught earlier episodes or for who haven't been following the Hyperliquid story, which I would find surprising because everywhere I open on social media, it's Hyperliquid everywhere. Maybe it's worth giving a little bit of a high-level overview of what it really is. So in our view, Hyperliquid is essentially really a 24/7 trading super app and increasingly a marketplace. We can think of it like eBay for banks, broker dealers, stock exchange, other entrepreneurs that want to plug into Hyperliquid's infrastructure and then also use it for their own purposes. It started in crypto perpetuals, but since then it's really become this everything exchange where you can now trade oil, gold, the S&P, all in one venue. And I think what we've seen recently is that a lot of its traded markets are no longer even crypto. So there's, a lot of interest right now around Hyperliquid. And as you guys said, you guys were early on the radar with your primer back in early 2025 as well. But on our side, it's also been on our radar for some time. We brought actually the very first ETP for Hyperliquid to the market here over in Europe last August. So for me, I think it's quite obvious why there's so much excitement around this, but the truth is it's not just one reason. It's a very interesting story from many different angles. So I would really love to hear from each of you, maybe starting with you, Chrisan, as to why or what really drew you to Hyperliquid first and what entices you about the story.
Thanks, Max, for the intro on that side. I think generally a couple of points in terms of Hyperliquid itself. In terms of how they went about doing the launch, there was, shall we say, low publicity attached to it. There wasn't exactly a mass amount of marketing. Kind of went under the radar. They had a massive airdrop, which obviously generated some publicity. But when you compare it to a lot of the other projects out there, it was very unique, very much out on its own. And in terms of the project itself, or the idea was kind of novel. DeFi trading on perpetuals. People had done it before, probably wasn't as successful. So you start to wonder, is this just going to be a copy and paste job? And that was, I think, the initial point which aroused the interest. But from that moment on, it just snowballed in terms of interest, volume trading, etc. And then once it moved into traditional assets, HIP3, shall we say, that definitely started initiating my interest, especially over the weekend, where you're trying to figure out where are commodities going to be opening up, especially gold initially, which there tended to be over the weekend. Any kind of event, gold is generally one part of the asset class, which tends to be the first mover. And so seeing the price discovery on Hyperliquid versus the traditional exchanges, it was quite novel, quite interesting. And then obviously once Iran, USA, etc., once that war kick-started, and then you had the mass amount of oil trading, definitely changed the full dynamics on that. It was really impressive. They did a brilliant job, brilliant execution by the team. And then when you see on front page news, Hyperliquid, this is the way to go around hedging out risk, definitely push the narrative forward on that side.
Thanks a lot, Chrisan. I could see you're gleeing and, you really have your trader hat on. I know you've spent a long time trading almost every asset under the sun, so Hyperliquid must personally be quite a present for you as well. Luke, would love to hear from you next.
Yeah, absolutely. I think, Chrisan did a really good job covering off on the product side. I think maybe what would be, interesting color that we can give is just how does Hyperliquid compare to other L1s on like an architecture level? And I would say like, I have some thoughts too on, why they were able to be as successful as they were, why it wasn't just a copy paste job, like you said, of other exchanges. I think, one of the things that stood out to me very early on when I found out about Hyperliquid, just, over the course of looking at all the new networks that are coming out for my role here, was that they, started off as essentially an app chain run in-house by a team or just like team run validators, but over time have evolved into this interesting like hybrid of an app chain and a general purpose chain. And the reason that I think, people have been excited about app chains for a long time. And I think for a while, they never really took off. I would say that Hyperliquid probably is the most successful implementation of that. And I think one of the things that stood out to me very early on was the fact that they were able to be, as I understand it, significantly more performant than most other decentralized perp dexes or just exchanges in general, because of the fact that the exchange logic is actually built into the network itself. And so I'm sure we'll talk more about that when we cover like HyperCore versus HyperEVM, but there are some interesting design choices that they were able to make down to really granular things like cancels getting priority over taker orders and things like that, we're able to adapt a decentralized setting where you have consensus overhead into, providing an experience for traders that's pretty comparable, as I understand it, to centralized exchanges. And Chrisan, keep me honest if that's the case. I know it's not exactly one-to-one, but it's workable, I think, for most people coming from a centralized exchange environment.
No, thanks a lot for
I
that.
definitely agree on that one, on that side.
And I would agree, like Luke, with your point about, the fact that it is kind of this purpose-built network or this purpose-built architecture really for that specific use case. And I think to your point, what we have seen over time as well is that kind of app thesis picking back up, that is actually where most of the value will accrue. And if you do have a strong fundamental business with a strong product market fit, you will actually accrue more value than the protocol layer beneath. But what they've done well, or what they've done just as equally well, is actually vertically integrate that infrastructure as well to actually capture value across the full chain. Josh, I think you're dying to get a word in. Feel free to tell us a little bit about your perspective.
I just think like the tokenization component of the like kind of what we're seeing on the tokenization side and the demand around tokens. Like if you look at what Hyperliquid has done, building a native L1 has been really hard to do. Like we haven't seen a highly successful L1 launch in the last like 1 to 2 years. And part of the reason is like we've seen new token launches be really successful. I think everyone remembers, the meme coin craze on Solana using pump.fun and these other sort of like issuance mechanisms to create meme coins. That was kind of the last time we saw buzz around like a new token creation like we're seeing on Hyperliquid right now. And, we can argue whether or not like Trump and Melania coins have intrinsic value, maybe in the same way that Hyperliquid does. I would argue Hyperliquid's obviously a much more thought through and developed project. But nonetheless, the novelty of the design is the fee burn mechanism also that the protocol employs, where the majority of the fees that are paid into the protocol are actually burned. So you really have like this disinflationary kind of mechanism that doesn't promote new token issuance, and you create a venue where you have $3+ billion of daily volume trading on traditional markets that are represented in a crypto native way, and also crypto native markets that are structured as perps, and you're burning the majority of those fees. You have a tokenomics model that we haven't seen anyone else employ right now. And you see, Ethereum and Solana and other networks are now trying to improve or increase their disinflationary schedules, their issuance model, to, I think, directly to compete with what Hyperliquid is doing here, where the majority of the fees end up getting burned. I think 97% of the fees that are paid end up getting burned, which means you create, a fairly, obviously not financial advice, but you create something that looks like stable value. And you look at the performance of Hyperliquid versus the rest of the market to date, and the asset's up while everything else is down. Obviously there's demand to trade it, but also I think the issuance schedule and the burn mechanics, keep it interesting from an investment perspective as well.
Yeah, I would agree with you, and I think the point that you raised about tokenomics is a very salient one, because I don't think we've seen newly launched tokens, to your point, actually perform very well over the last cycle. And this actually feels very purposeful from the very get-go, in that they didn't actually have any external investors and they were very community aligned from the beginning. And this just feels a continuation of that kind of fair approach launch that they started from the very beginning. And they create now this very strong flywheel where more activity on the platform generates more fees, and therefore that feeds back into the token's value. But I think I want to kind of peel back here a little bit and go back to you, Luke, and maybe we can go into what we said we would go into a little bit more of the architecture. And I think you briefly touched upon it, that there are actually kind of two segments, let's say, at a high level to Hyperliquid. You obviously have HyperCore, which is maybe more the trading engine that you were alluding to, that it's built in very specifically to the network. And then on the other hand, you have a Hyper EVM, where you can also build applications compatible with the Ethereum virtual machine. So maybe can you break down in layman's terms, I know that's difficult, but as easy as possible, in case my grandmother may be watching this episode, what that kind of really means, and why that is a different approach to what we saw in the past with either, general purpose layer ones or with trading applications.
Yeah, happy to. So I guess if we're going for extremely layman's terms, I would just say, think of HyperCore as the exchange and Hyper EVM as something that looks a lot like Ethereum, that's secured, where they're both secured by the same consensus and the same validator set. So you have the Hyper EVM, you have HyperCore. They're sort of two separate environments, but transferring between them doesn't require like bridging in a traditional sense, like it would if you were to go from something like Ethereum to Solana, which is important. I think in terms of why this design, also I should just, I guess, caveat, like the slightly less layman's term explanation, HyperCore is also where things like staking functionality live. And so really I'd say like the beating heart of Hyperliquid is HyperCore. All of the things that make Hyperliquid are on HyperCore. But what's I think really powerful for them about adding an EVM environment alongside this is it sort of gives them like, I guess to take a step back, right? Outside of store of value, I think it's pretty apparent to everyone, and has been for a while, that trading is without a doubt today and probably forever the most valuable use case of a blockchain, the most revenue generative use case of a blockchain, the thing that's going to make a network the most valuable, right? Like you saw it with Ethereum with NFTs, you saw it with Solana with meme coins, and to a lesser degree other like perpetuals, but really Hyperliquid has come out and obviously completely dominated the perpetuals market. So in my mind, the reason that their approach to this, I think I call it in my article like a general purpose app chain, or maybe that's not the exact terminology, but essentially what it is you have an app chain where, like you mentioned, Max, you verticalize the most valuable business and you build an incredible product. You have all the revenue generated from that. the other thing that's really interesting is it's actually like an approach to scaling too, right? So historically, if you had a really high throughput EVM network, I think for most of the teams that are building that, you're building that so that you can support things like the Hyperliquid exchange, but
Yeah.
built as smart contracts. So by building that, doing what Hyperliquid did and building that like ultra performant application into like the bare metal of consensus, for lack of a better term, you actually like take a lot of the load off of the general purpose side of the house that otherwise would have to be there if you were like a Solana, for example. And so by adding Hyper EVM, like realistically, the vast majority of the revenue generated on Hyperliquid is happening on HyperCore, and that will probably always be the case. But having Hyper EVM alongside that sort of gives you like the option upside of like, hey, over the next 10 years, whatever people figure out that is useful to have in a financial system that can be built on Solidity smart contracts, it can live here and it can also natively interact with HyperCore through compiled contracts.
No, exactly, Reed. It helps it grow its potential network effects to that front as well. And I think, actually this is a great kind of segue to the next section. We've seen that obviously you guys have been really in the weeds with regards to Hyperliquid and really are experts when it comes to this subject matter. So I want to take a step back before we really go into the ins and outs of Hyperliquid staking and how that actually works in the products that we actually have. But I want to go a little bit more inside Figment first and hear about the Figment story, because I think it's worth telling for people out there. And maybe this is more for you, Josh, to walk us through Figment as a business, what you do day to day, and how and where you really sit in the landscape.
Yeah. Happy to do so. So Figment's been around since 2017, and the founders made a pretty, I'd say a pretty smart bet at the time that, Bitcoin had this, the way that Bitcoin was launched into the world is not something that could ever be replicated again, right? You can't just build a proof of work network, have an equal and fair distribution of tokens, have it be like fairly energy extensive in order to mine new tokens and have the founder fully disappear before it becomes, valuable from a global perspective. Just completely like a different, like that's not going to ever happen again. But the second part of the thesis was there will be purpose-built blockchains. And what does that actually mean? And what operating system will they operate on top of? So Figment was designed to specifically solve the problem of how do you run the operating system of something like Ethereum, Solana, Hyperliquid, the 50 some odd other tokens that we support that run on proof of stake validators rather than on proof of work mining. And to our founders' credit, there have not been other proof of work tokens that have launched since Bitcoin that have managed to gather like, a meaningful market share. So what we do is we operate the validators that help customers participate in the process of validating a block. And that kind of sounds like industry jargon rolled up into one, but really like each one of these blockchain networks, there's a network of validators that are attesting or voting on blocks, and blocks contain transactions. So you're effectively playing like a governance role. You're voting on the state of the network and you're incentivized for doing so. Each blockchain protocol, we were just talking about Hyperliquid, but Ethereum, Solana, they all kind of do it a little bit differently, but they incentivize you with some sort of new token issuance and some sharing of fees that are paid into that blockchain in order to run validator infrastructure on a particular blockchain. And so that's what we do at the end of the day. We're B2B. So, our clients are folks like you guys. They're ETP issuers. Like I said before, they're banks, they're brokerage platforms. We have over 1,500 customers across the globe, but the majority of them are, they're doing two things. Like 21 Shares is a really good example. You guys have large balances of tokens because you run, ETPs that hold those tokens within them. So you could just hold those tokens and put them in custody and not do anything with them. But with proof of stake, you can turn, an unproductive asset into a productive asset. And so you can stake your Ethereum, stake your Solana, and earn, a reward rate for doing so, which is the annualized amount that you get for performing validator services. So Figment does that for about 6.5% of the Ethereum network, 6.5% of the Solana network. Hyperliquid, we're the largest non-foundation validator. We run that in tandem with a custodian called Anchorage. And we'll say that, what we do at the core of it is we run that, the back end, the operations, the reporting, the risk management, all of the functions that you as an institutional ETF provider need in order to be able to offer a product to your clients and confidently say, hey, a portion of this product is staked, 75%, 80%, et cetera, whatever that percentage may be of your ETF is staked. And we chose an institutional provider to do that with.
Yep.
Diligence process. So at the end of the day, that's what Figment does. B2B, you can stake to our validators because validators are public infrastructure and you can stake to any. But when we're, talking to customers, designing and thinking about who we're building for, it's really more for, at 21 shares than, Max, I hope your grandma does stake some hype, but the product is more for 21 shares than maybe your grandmother.
I'll let her know that maybe it's not she might watch and she might be interested and check with you guys, but I'll let her know and I'll save her some time. But I think that's exactly an interesting point that you did raise, right? That there are a lot of nuances, and there's you mentioned 50 plus different tokens or different networks that you guys do support, and I think that is what actually separates that from a serious staking provider from just operating individually or even as an institution, just a couple of nodes. And I think those nuances are difficult to kind of walk through or understand and then be able to actually commit client assets to. And I think that's what's very, very impressive, or it's important to know, because I think in TradFi, it's not too different. We've long separated different service providers based on their expertise and different functions. And I think, doing that all in-house in crypto is very difficult, in a robust way when it comes to asset management.
Yeah. And Max,
Yeah.
I would say the core difference too is if I lose a stock, I just go reprint the stock certificate. It's no harm, no foul, right?
Yeah.
To recover a stock certificate. But if you lose your crypto, if you lose the private keys, the assets are gone forever. So you really do need, again, Figment's non-custodial, but it's just a different model when, there's no way to go reprint a stock certificate or say, what happened to those rewards? Those rewards were lost or et cetera. Something was wrong with the process. You're dealing with, the transfer, the underlying asset itself, not like a certificate representation of it. And that just completely changes the operational risk calculus and why you need specialized providers. Absolutely.
That makes a lot of sense. And I think this is a good time to maybe bring you in, Chrisan, because obviously Figment do tremendous work from our side, but takes two to tango here. And we have to have a little bit of brain power on our side who sets the plumbing up as well. And I think that's a lot of what your team is taking care of as well in terms of selecting the top-notch players in each part of our stack. So kind of Figment, I promise, didn't actually pay us to do this, but what actually drew you to Figment, and kind of give us some color in how that actually works in practice when it comes to selecting service providers.
Yeah, sure. So I think, as Josh and Luke have mentioned, I mean, staking is a non-trivial process. It's not, press a button and off we go. There's lots of nuances involved. Every chain has its nuance, and every upgrade can change, how it can perform and how the staking operation model works. This requires a lot of research, right? It's again, not something you can just, it's a one page and off you go. You really need to know the ins and outs of every chain, every way, how the staking works, how an epoch works, how the slashing model works, how the gel time works, like all of these nuances, you really need to know it back of your hand. And doing all of this in-house is, I would argue, an almost impossible job, right? If you're not a staking specialist, you're kind of an all-in everything model, very hard to specialize across the majority of chains and still do an optimal service. For us, staking is obviously a very key part of our products. It's part of the USP. We obviously want to be working with staking providers who not only can provide optimal staking rates, but also have good performance in terms of uptime, in terms of the validators, but also, when you have a question, can they answer it? Can they give you a detailed answer? Can they be precise in their answer? Can they give you more information than what even you requested, because they're well versed on the chain. And this is definitely some of the points that we look towards. But then there's also the security element. As Josh mentioned, you lose something in crypto, that's gone. So you need to have extra level of security throughout. not just from a, shall we say, hacking point of view, but just all over the system on that side. As I mentioned, some chains definitely have a slashing element towards it. So what's it based on the historical level? Like where have you performed on this chain over the last 1, 2, 3 years on this side? So this is definitely some of the criterias that we look towards from our staking providers. And Figment, we asked you guys many questions, and every time you come up top trumps, and I'm quite sure you'll be the first one to say this. I'm quite thorough in my questioning as well, so it's it's a good partnership on that side from my point of view.
I can confirm your thoroughness as well. So no doubts that the questions Chrisan will pose questions if he has any, and I think this brings me back to you, Luke, or maybe it ties a little bit specifically back now on this front to Hyperliquid. Given the nuances of each network and of course kind of the youth of Hyperliquid itself, it's exactly why we rely on players like yourselves. And maybe this is a live test of you guys being able to answer the questions. And how did you guys end up to be actually or become the largest non-foundation validator on the network? I know, Luke, you authored the deep technical analysis that we talked about back in April 2025, I think, but it was before even crypto Twitter knew about it. It was before institutions even, had heard the word. So how did you guys end up? What did you see early, and how did you get to where you are today?
Yeah. Well, I guess first thing I would do is I'd give at least pockets of crypto Twitter a lot of credit on this. It was really crypto Twitter. That was how I found it. It was a smaller, segment of people, of course, than it is today. But I think in terms of, let's see, where to kick off, how did we end up being the largest validator on Hyperliquid, excluding the foundation? I think, a lot of it comes down to what Chrisan was just talking about, which is, we've, and also context Josh gave, we've been in the industry for a very long time. And ultimately, given the nature of what staking is as an activity, right? There's a lot of things that you can do in crypto to potentially make like extremely significant multiples on your money. Staking is not one of those things, right? It is really like the closest thing in crypto, with a big asterisk here, to like a risk-free rate of return within a network, right? If you assume that you're denominating whichever like base asset, whether it's Hyper, ETH, or whatever else, the lowest risk thing you can do in theory with no smart contract risk or whatever is staking. Now, of course, the caveat is you need to have a provider that's going to know exactly what they're doing to make sure that risk profile stays as low as possible. And that's especially important when your maximum upside is like on Hyperliquid, it's 2.25%, right? Ballpark, maybe it's 2.5. But all that's just to say, I think that, our existing relationships, having been around for a long time and really being trusted by the largest participants in the industry was pretty critical in us getting to that point in terms of just the AUS that we have today.
Luke, I would just add on to that. It was one, we had the materials and our teams were enabled to go out and talk about this because our protocol team with Luke, found and was working on Hyperliquid really early. So we've been in the rooms having conversations with institutions since before they even, before they were even trading on it. And then they start trading on it, and then they start having more questions about it, and then they want to launch a product on it. So that seems to happen quite often. It's also global, so it's not related to demand in North America or demand in EMEA or demand in APAC or demand in Latin America. It's pretty much across the globe, and we're working with. There are digital asset treasury companies. There are large venture funds. There are large trading firms that hold, large portions of Hyperliquid. And for a while, actually, many of them just felt like holding it like a static balance. Like they staking was a little bit of an afterthought. And so it just took, a couple quick conversations with a few of those folks to help us, to help convince them that there is a lot to, there's a lot they're effectively leaving on the table if they're not actually staking their Hyperliquid or their Hype token. The one final plug I'll give here is we did partner with Anchorage on our Hype validator, and that's been an extremely fruitful and valuable partnership. If you think about, the ability of an institutional custodian to also help attract client assets and get those types of customers comfortable staking, while holding their tokens in custody. That was another big aspect of the, the sales pitch that I think, won a lot of larger institutions over. But truly global effort and really, helping institutional holders of the asset understand that they can stake it. And, if you have a $100 million Hype position, they're leaving, $2 to $3 million of rewards on the table each year. That's significant. That's at least paying fees for some other parts of your business, more capital you can return to your investors. So that's really what drew us there, Max.
Makes sense. And I think, yeah, the Anchorage obviously is a big stamp of approval there as the only federally regulated crypto bank in the US. So I think that's obviously a clear stamp of approval as to the work that you guys are doing. And kind of just dawned on me, Luke, when you mentioned that kind of staking is, let's say, the risk-free rate of crypto, that you guys are kind of the fixed income guys of crypto, therefore, which is maybe a nice little analogy. But in terms of running a validator itself, is there anything you guys can share with us in terms of how does that actually compare to, running one on Ethereum or Solana or something a little bit more general purpose? Are there any nuances really that we can highlight with regards to the operations that you guys do under the hood? I think no slashing is perhaps potentially one of them that is worth calling out. And then I'd also be interested from your guys' perspective, the yield in terms of the staking yield, kind of where is that actually coming from? And maybe for a traditional investor, kind of what does that mean? Because if we think about staking as a way to continue to secure the network and make sure transactions that are happening on that blockchain continue to tick along, how do we think about the stability of the yield on Hyperliquid that's being driven today?
Yeah.
Happy to throw that out to anyone here.
I can give a quick pass. So I'll just caveat this by saying my DevOps team could go extremely in the weeds on all of the nuances. But I think for the broader audience, one of the most significant things to call out is that running a Hyperliquid validator, I wouldn't be shocked if this was covered on previous episodes you guys did. Running like the entire validator set sits in Tokyo today. Large part of the reason for that is proximity to other large centralized exchange servers and that being important for, serious traders. But for us, it's interesting because I think on most networks, right, decentralization, geographic decentralization is a really big thing. I think on Hyperliquid, it was a very intentional decision that they made to say we are going to trade off the geographic decentralization for higher performance. And, I think looking back over the last 2 years, it's pretty clear that was like a trade-off that the market's very okay with. There are a handful of other components too that are unique to Hyperliquid, but a little bit maybe more in the technical weeds and, just being mindful of time. I know you mentioned no slashing. That's another thing I want to touch on. There's a little bit of an asterisk there because, for vanilla staking, there's no protocol slashing. And so what that means is it is still in theory possible that governance could together and through social consensus do slashing, right? But at a protocol level, it's not like Ethereum where there's some action you could take that will automatically result in the validators being deducted. The one other caveat I'd give to that, at least for today, and I expect there will be more surface area for this in the future, maybe with HIP4 going live, but with HIP3, which is custom perpetuals, like we discussed, things like gold or pre-IPO stocks, basically all the stuff that like Trade XYZ and others are deploying on Hyperliquid today. In order to do that, in order to have the rights to do that, they have to stake HYPE. And there's a pretty well-defined list of criteria under which that HYPE could be slashed, but that's only relevant to HIP3 deployers. So if you're just a vanilla staker, like if you're, HYPE from an ETF or just a regular holder, then those risks don't apply to you.
Luke, I just also add that at the most basic level, the other core, there is a really major difference from Ethereum and Solana. And one is there's a limited number of validators on the Hyperliquid networks. There's only 27 validators, and 5 of which are run by the Hyperliquid Foundation. So there's a much smaller universe of validators, and you need to, in order to actually become a validator on the network, you need to have a certain amount of stake sitting on your node. Whereas I can spin up an Ethereum validator tomorrow. I need to have at least 32 Ethereum on that validator, but there's some nuance there, but it's the same thing with Solana. I could spin up a Solana validator tomorrow and just have a lot of stake sitting on it. In order to actually be an active validator on Hyperliquid, you need to have at least, I think today it's 800,000 or 850,000 HYPE to even be like the, and if you were to get that much HYPE, you would then knock number 27 into an inactive state. So there is a little bit of gamification. So actually choosing a larger validator on Hyperliquid is really important because then you don't run the risk of that validator of someone else. Let's say someone decides they want to run their own infrastructure. There's a large delegation that's made out of, some crypto fund that decides, hey, we're going to go rogue and build this in-house. If you're using another validator that's towards the lower end of the spectrum in terms of the asset stake to that validator, you do run the risk of that validator going in, and then you would need to stake and restake to a different validator. So there is, and that's, a 14-day process. So there is a little bit of a concern there around size. And that's a nuance given, you're staking to public infrastructure versus on Ethereum, you run, one validator per one address, one custodial wallet to one validator.
No, thanks a lot, guys. That's exactly kind of what we wanted to have you guys on board, to be able to showcase that, there is a lot of work that goes on behind the scenes, and it's not just a click of a button, boom, I'm now staking Hype, and I just go about my day. So thanks a lot for giving the color there, and it's exactly kind of the proof in the pudding as to why we work with people such as yourselves. But again, there is work again that goes on our side here, and I think Chrisan, I will be curious to hear from our side, what is the work that actually 21 Shares does need to do when they think, or when we think about spinning up a staking ETP, because there's still a few considerations, I would say, when it comes to structuring this kind of product, especially in terms of, liquidity management and other operational risks.
Yeah, definitely. So, and again, I think I said it before.
Yeah.
I keep saying it again, insofar as staking is definitely not a trivial process. I think that tends to be an image out there that it is literally stake X and off we go on that side. Regarding general staking and also regarding Hyperliquid, for our ETPs and ETFs, we need to be able to facilitate redemption. So if anyone or an authorized participant places a redemption, they need to make sure that they can get hold of the coins in a T+1 settlement process. From Hyperliquid's point of view, unbonding time is 7 days. So the point of when I unbond, or shall we say stop staking, it'll take 7 days before I can actually claim these coins. So for us, we need to manage the liquidity management piece, but also at the same time optimize yield. It's a trade-off between the two. You go either side, you either have high yield, but then you run the risk of not being able to facilitate redemption, which is not great at all. One little bit, you'll have market makers and APs on your case, and it's not good from a reputational point of view. But then on the other hand, if you don't stake enough, you have an unproductive ETF or an ETP. So your yield is almost negligible, and I think at the moment network rate is 2.25%. So that can really eat into the overall yield that's earned on the ETP. And going back to what you mentioned earlier, Max, your grandma's not going to be happy if she switches to our ETP as opposed to the coin. So we want to try and get her the best rate of return as possible. So for us, we have our own staking model where we're utilizing both the redemption flow, where we're seeing like markets moving, and then also in terms of the unbonding times as well. So in that regard, that's how we're trying to facilitate and optimize yield on that product. And also if we're able to get borrow in place, that can also help facilitate a higher utilization rate on the product as well. And then also final point is also, I touched upon it before, working with staking providers who can always get the highest optimal yield with a Figment on that side. So cool.
Thanks a lot, Chrisan. And I promise to everyone who's watching this, we do actually let him sleep, so don't worry about that. I know he does a lot of different things. He's even on.
I don't know, Max. I've seen Dr. Chrisan on multiple continents, and I'm convinced that he does not sleep. So
I'm more convinced that just means that there's actually two croissants rather than that.
There you go.
I just
Cool.
beam away. That's what I do.
Anyway, I think it's interesting now to kind of zoom out into like the broader ETP Hyperliquid ecosystem, because when we're talking about staking Hyperliquid here, and we're talking about in traditional investors that actually are interested in the Hyperliquid story, it's no longer, and it's not a small amount of money that we're talking about, and the numbers are quite telling. I think globally now there's around 280 million of assets under management across the global suite of Hyperliquid ETPs. And actually, they only launched, I believe, around 5 weeks ago in the US. So it's not been a long time. And actually, across the first 10 days of Hyperliquid spot ETFs in the US, they actually had seen more inflows relative to their asset size, relative to the asset and market cap, than actually all the other spot ETF launches to date. So that's quite an impressive number. And I think, it does give us a little bit of read on investor appetite here. And it's actually something that we touched upon earlier in the podcast as well, but it's good to see for the crypto industry as well that we do see divergence in performance, and that it might be a read that we're going a little bit back to fundamentals, or that fundamental investing is becoming more important in crypto. But curious to see what your guys' read is here. Maybe starting with you, Chrisan, in terms of what do you think this tells us about traditional investors' appetite for hype?
Thanks, Max. So interestingly, I know you mentioned the figures, which is great. For us, for our ETP in Europe, we wanted to get it out earlier. We had a significant amount of demand from our clients to launch this ETP, and it was almost we couldn't because we didn't have enough market makers lined up because they also needed to hedge up their risk. Became a bit circular, but there was definitely pent up demand on our side to launch this ETP ASAP. And as you know, as soon as we did launch, it gained significant amount of traction on that side. Going back though, in terms of the actual story itself, we kind of covered it at the beginning of this call. Hyperliquid's basically revolutionized or changed everything. It's turned a lot of TradFi on its head. 2 points specifically. One is the whole weekend trading. They've literally reinvented the wheel, and it's pushed all, shall we say, TradFi markets to go down that place. Whether they like it or not, they have to do it. If they don't, they can't keep up. And this is realistically on the basis of Hyperliquid. They were there ready. They're waiting for the moment. The moment came with the whole Iran war, etc. People were able to hedge off their risk accordingly on both oil and in the commodities, and slowly in FX. And the price discovery was pretty much on par where it opened on a Monday morning on that side. So from that point of view, that was strike one in Hyperliquid's favor. And then also on the back of that, perpetual futures, which is very much shall we say, a crypto native product. TradFi has standard futures. Crypto basically went down the whole perpetual future route, and this is coming all the way from 2016 onwards, where it just kickstarted popularity. They've pushed out also into TradFi space. So now you're having regulated exchanges also now looking to launch, perps as opposed to futures. And just for any listener out there who isn't aware of the difference between a perp and a future. From a very high level point of view, a perp has no expiry date or maturity date as opposed to futures, which has a constant roll, like a quarterly or a weekly roll in that regard. But also to tie back a spot versus the future or the perp, there's a funding charge that's allocated either every hour or every 8 hours to make sure the two don't diverge either side. So if the perp is trading above the spot, longs pay out, and vice versa on the other side. But circling back, Hyperliquid have basically, as I said, revolutionized almost TradFi to some degree. This is something probably all the main, shall we say, centralized exchanges secretly wanted to do, never really did it. It had its own, I want to say quite Chinese wall, but pretty much along those lines. Hyperliquid have come along, knocked down that wall, and it's almost a merger between the two. And now you have an exchange which can almost have anything and anything trading on there, and you have enough TradFi people on there also tapping into it on that side. So for me, it's a great story, great project. For Hyperliquid itself, I think the next phase is going to be how well do they deal with the competition, because imitation is the sincerest form of flattery. And now you're seeing it more and more, everyone's trying to emulate them to some degree or other. So next step will be, how do they deal with the competition on that side?
Agreed. Yeah, I think it's to your point. I think it's for allocators, right? It's a pitch that sits, quite neatly on their desk. It's something that, if they weren't previously investing in crypto, it's something that they would still be able to understand as an underlying business. And maybe from a valuation perspective, there's more apples to apples comparisons that they can run on actually evaluating as a business, as opposed to maybe some of the more generalized smart contract platforms like Ethereum and Solana, where you had to be a little bit more creative in getting that pitch to a traditional investor and hoping that they catch on in terms of how to think about it as an asset.
Yeah, you pretty much nailed it. I think from a TradFi hat, trying to explain what Solana and Ethereum and a lot of the chains are, or the use case maybe wasn't a quite straightforward win. With Hyperliquid in their head, you can easily like describe the format to them. And to Luke's point as well, when you're talking about HyperCore and Hyper EVM, slowly that whole picture can come into place where you have, shall we say, your HFT side, which is the HyperCore, write some kind of smart contract on the EVM. The two are completely compatible to a large degree, no bridging, no bridging per se. And suddenly you have another product that you can start shipping out as well. So yeah, it's a great project, great idea.
And traditional investors, at the end of the day, they do look at, fundamentals, and they do look at numbers, and they do want kind of the proof in the pudding. And I think on that side as well, Hyperliquid obviously has a very strong case in that last year. I think they generated just shy of $1 billion in revenue, and they're powered by, as far as I'm aware, just around 10, 15 full-time employees. So looking at it from that angle as well, it's a very kind of circular pitch that it's easy for allocators to understand. I'm curious if it's something similar that you guys are witnessing on your guys' side as well, from the Figment side.
Yeah, absolutely. I mean, I think you've hit like 95% of the puzzle, but there's a 5% piece of the puzzle that sort of completes the circle, but that's also regulatory clarity.
Uh-huh.
In North America, especially in the US, having regulatory clarity, at least it's not set in stone yet. But we had our first onshore Bitcoin perpetual listed by Kalshi just a few weeks ago. I think it was literally 2 weeks ago, actually. And I know Coinbase is gearing up to be able to offer some sort of, ongoing perpetual market. But we have the Clarity Act now that's, being debated amongst the Senate, which would give the CFTC oversight for regulating things like perpetual futures that are based on crypto prices, which is, makes sense given the commodities market regulator has historically been the CFTC in the United States. So I think institutions, all of that's great. Like, hey, we have a way to have risk on weekends, or a way to express a hedge on weekends against, military action in Iran is the greatest example that I can think of so far, hedging against oil prices, or hedging against corn futures, or whatever the commodity may be that was impacted. Institutions get that. I also think people are looking for, just to call it at the most basic level, like the demand for Hyperliquid is very obvious. The protocol was trading around, or the token was trading around $4, and is now, it's traded above 70 this year. So, it's had one of those meteoric rises that also gets people's attention, and they're asking, well, why did that happen? And then they dig into the fundamentals and they realize that it's not, it's not a meme coin craze. It's not pump.fun creating, silly tokens. It's something that has actual value to financial plumbing. So yeah, we are seeing significant demand from, larger institutions. We're seeing significant demand from, the VCs who are looking to deploy to new L1s, and they haven't had an L1 to deploy into. And I would say, I think this is only the start of the Hyperliquid story. Like, this protocol was sort of on our radar throughout most of last year until we launched our validator at the end of last year. And it is now one of the, I'd say, 3 most common protocols we're talking about at Figment, alongside Ethereum and Solana, which says a lot, just given the rise that they've had over the last 6 months.
Yeah, and just one little nuance I would add as we're talking about this, that I think is an interesting thing to flag. Hyperliquid is an L1, but to your point, Max, when you're investing in Hyperliquid, you're not investing in the L1. You're investing in an exchange. And it just so happens that exchange is built as an L1 because that was the optimal way to get the performance that the exchange needed to be what the exchange is. But unlike Hype is the gas token of the Hyper EVM, but the vast majority of like what makes the Hype token is this buyback engine coming from the exchange. And so, it's an L1, but that's not really what the value prop is. That's just sort of how you get to the value prop.
Yeah, exactly.
Yeah.
No, I would agree with you that in that sense, as an investor, also, if you look at the early days of the internet, right? What do the people remember from back in the day? They remember the applications they use, the things that actually help them on a day-to-day life. And I think what we're going to see in crypto more as well is that infrastructure kind of fading into the background, and that shouldn't be the value proposition of something, it should really be the means to get you to a specific result or to solve a specific problem, but should not be the specific solution. It should be a means to get to the ends, rather. Listen, guys, I wish we could continue talking for a long time, but I think, our listeners will probably stop dropping off if this goes on for any longer than an hour. And also, I do need to get on to do some other work. I mean, on our
You
side,
need
it's also
to you need to tell your grandma to buy the Hype ETF,
Exactly.
which you can stake to Figment afterwards as well. That's what you need to do, Max, after this call.
Yeah, sure. Yeah, buying at an all-time high. That's always been sound sound advice. But all jokes aside, thanks a lot to the three of you for being here, for taking the time. I think there was a lot to learn in today's episode. And if you guys missed the earlier episode we had with an early Hyperliquid contributor, to everyone watching this, please go ahead and check it out. It's done in 2 parts. And here I hope you enjoyed, going a little bit more under the hood and a little bit about the nuances as to how Hyperliquid's architecture makes it as successful as it is today, and also learning really firsthand from experts in this field. Thank you to the Figment team, and thank you obviously to Chrisan for joining me today. Chris, yeah, so thanks, guys. Is there anything else you guys would want to add before we let our viewers go?
Stake hype.
Stay hype.
Yeah, buy our ETP and we'll stake Hype.
Well, I would say be hyped about hype. I think
There
this
you
is a far more, than a crypto story. I think it's a true, as we said many times today, modernization of financial infrastructure. And I think Hyperliquid is definitely here to stay. Thanks again for all of you, and for everyone watching this. Be sure to, check out Figment, follow their, social media. There's a lot of good insights coming from their side as well. Be sure to also like and subscribe if you're watching this on YouTube or Spotify. And I hope to see you all in very soon as well. Take care. And until then, thanks for listening.
Thank you. Bye.